Hi, Sean. Ladies and gentlemen, good evening. Firstly, thank you very much to Dr. Mulholland for this invitation. It's very much an honour to address you this evening at the MacGill Summer School. I'm going to come at this from a different angle. If Stephen came from left field, I'm going to come at it very much from a practitioner angle, but I don't think you'd expect anything different from two economists to give you two views. Three views? Yeah, there'll be probably a few more than three views by the end. 4 years ago, almost to the day, Ireland hit rock bottom in the eyes of global investors. The bond market at that time suggested that not only were we going to restructure, but that we would only get that the investors in our bonds would only get back about half of what they put in. Ireland could have been where Greece is today. The country's recovery since then has really been extraordinary, and I think that's something that's often underestimated. The government and the rest of us in the Irish authorities fought very hard to avoid default at that time. Some help to ease the debt burden was needed and gratefully accepted along the way, particularly from our friends in Europe. Events over the last few weeks in Greece, though, have brought into focus that the counterfactual would have been a nightmare from Ireland's point of view. Who would fancy government default leading to a near breakdown of commerce, the €60 limits to cash withdrawals as we've seen in Greece, the potential departure of critical foreign direct investment and the high-value jobs that would go with them? Ultimately, forced euro area exit couldn't have been entirely ruled out, and I think certainly that would have set Ireland back a long, long way, if not a generation. Instead, we're now borrowing money for 10 years at less than 1.5% per annum. Unemployment, Patricia talked earlier about it, is peaked at over 15% back in, I think, February 2012. It's now below 10%, and it's falling at a rate of about 1/10 of a percentage point a month. Employment has increased about 110,000 from the trough, and real wages are starting to grow. Workers are certainly beginning to see an increase in their hours. In short, the immediate future looks bright. Yet we've been here before. I often say that if we could have stopped the clock back in 2001, we were in very good shape. There were no excesses, private and public debt was low, and the credit bubble was yet to blow. Perhaps, though, Ireland has a second chance. So if I can doctor a well-worn phrase from Oscar Wilde, just by one word, to lose one chance may be regarded as misfortune. To lose both looks like carelessness. It may not be 2001 again. Certainly the position is not quite so promising as it was back then. Debt levels are much higher, albeit falling. And for structural reasons, which I'll allude to later, growth in the developed world is likely to be lower than in the 2000s. Yet Ireland is about as competitive as it has been at any time since 2001. We're now finally compliant with European rules, and income per capita is growing by about 4% compared with less than 1% in the euro area. There are three questions I'd like to pose tonight, the questions to which may determine whether we seize our second chance to take the economy in the right direction. First, what is our economic model and how do we protect it? We've heard a little bit on that already tonight. Secondly, have we learned our lessons? Probably the key question you want to know answered. And third, do Irish economists look at the economy through the correct lens? And will we read the warning signs next time? And here, there should be some parallels with Stephen's presentation. Ireland's economic growth model, development model, is export-led. It is really hard to see any other option for a country of 4.6 million people. Moreover, it's a development and export model led by multinational companies, which in the main are foreign. In the 2000s, we accidentally tried something different for a time: domestic construction-led growth. This priced out our exporting sector, drove up costs, wages, property prices, although it was kind of difficult to disentangle which led which. Crucially, though, the export model was not broken. Once our price level fell by 5%, wages on average by a similar amount, commercial rents and property prices, house prices by over 50%, we were able to breathe again. Certainly our exporters were able to breathe again. And recently we've attracted a new wave of FDI, the service companies and the social media companies, which are to the fore, certainly in the United States. But other key sectors were already recovering: tourism and agribusiness. And then on top of that, over the last year, we've had this significant bonus of the euro's depreciation on top. I mentioned earlier, it is a fact that Ireland is as competitive as it has been at any time since 2001. We have to protect that, because the underlying picture is that between 2008 and 2013 we made a lot of ground, but since then we're not making any further progress on an underlying basis in terms of prices, costs, wages. And we can't rely on transitory currency gains either. To keep our competitive edge, I'll outline at least two levers which the state has some control over from a cost point of view, apart from public sector pay. One is prices that are influenced by government policy, so what is called in the jargon administered prices, and the other one is property prices. Much of our goods price inflation is generated outside Ireland. We can't control it, particularly energy and consumer products. But service prices are largely domestically influenced, the primary drivers being how close our non-traded sector is to full capacity. The other key variables are changes in those administered prices and rents. Administered, or maybe more simply what I'll call loosely public sector prices, are up more than a quarter in the last 5 years, an annual rate of over 5%. Whereas private sector prices are down 10% in that period, so falling at a rate of around 2% per annum. Understandably, fiscal consolidation and health policy had something to do with it. Hikes, for example, in excise on tobacco, alcohol, but also from a fiscal point of view, motor fuel increases, certainly the excise on motor fuel. But there are other culprits. Large price increases for third-level education, public transport, health insurance, the TV licence and motor tax. We should aim for growth of no more than 2% in these administered prices. Ultimately, that's the ECB's inflation target. But rarely we look at these in aggregate. Greater competition in sheltered sectors would help. And to put this in context, in retail, where competition is still intense, even though retail sales have bounced significantly this year, retail prices on average are down about 4%, so there's a lot of discounting still going on. We also need to think differently about property prices in this country. Everyone perks up now when you start talking about these. To me, they may well be the biggest swing variable with regard to our competitive position, apart perhaps from fluctuations in the value of the euro. Stable property prices growing no more than consumer prices should be a public policy goal. Many in this room may even, but certainly at a political level and within the authorities, are exercised by rising rents. Yet few seem to link rents to prices. Ultimately, buying a house, you're just purchasing a discounted stream of rents from the future. Where rents go, property prices go in the medium to long term. So what can be done in practice? The state can influence both supply and demand. We need to make it cheaper to build houses by freeing up land, speeding up the planning process and reducing burdensome regulation. And the experts here later this week, on Friday I believe, will be discussing, I'm sure, the supply issues in more detail. On the demand side, the central bank's new mortgage rules have already seemed to have had an effect on the market, and this should be cheered. It seems to have cooled price inflation already. In the end, though, I think it is time for a shift in the culture and attitudes towards property prices. Property prices rising above the rate of inflation are a bad thing. So let's implement the required actions to change it. To finish on this topic, looking at our model, the property bubble of the mid-2000s compensated briefly for the loss of export competitiveness it caused. We can't bank on striking oil like Norway. If Ireland is to lift living standards in the long run, there is no alternative but to remain fighting fit. So have we learned our lessons from the crisis? If the goal is to avoid going from boom to bust and back again, it's far too early to say. Certain actions are meritorious. We've passed the Fiscal Responsibility Bill and the Fiscal Advisory Council is up and running on a statutory basis. Statistical fiscal transparency has certainly improved and is now towards the top of the class in Europe. The central bank's macroprudential rules were brave and necessary. Regulation of the financial system has been beefed up. But have we really thought strategically rather than tactically about economic stabilisation policy, particularly fiscal policy? Our record since independence is one of pro-cyclical policy, spending and cutting taxes when flush, and then slamming on the brakes in dark times out of necessity, when neutral or looser budgets often would have been preferable. The ratio of government debt to economic output rose from less than 50% back in 1975 to 100%, or just under, in 1988, all the way back down to 24% at the low in 2006, and back up to a peak of 123% in 2013. The recent peak, I should say, headed for 110. Cultural change is required. High structural deficits mean spend now, pay later, and the next generation pays more tax or sees fewer public services to service interest payments to creditors. I certainly don't want to shift that burden onto my own daughters to have a better standard of living temporarily, but we rarely speak this simple truth. Why can't Ireland behave like Finland? It's a similar size exporting nation. Why can't we behave like they did after their crisis in the late 1990s, mid to late 90s? It ran a primary budget surplus, and without getting too technical, that's the budget balance excluding interest payments on our government debt. It ran that every year until the crisis, the global financial crisis of 2009. But even then, it never ran a primary budget deficit of more than 1.5% of GDP through that crisis. Belgium, to whom bond market investors often now compare Ireland, has a 30-year record of fiscal prudence. So investors who lend us the money to finance our deficit ultimately constantly ask us about medium-term budgetary plans. The Fiscal Advisory Council and overseas authorities have also pushed for more rigorous detail out to 2020. Such plans, with the aim also of keeping the primary budget in surplus, would go a long way to cementing market participants' views or tentative assessment that Ireland is a new paragon of fiscal virtue. However, I'm not sure we can do away with pro-cyclical policy without adapting our political system. Without straying too much into this area, to behave strategically, to me, means not having to fear immediate consequences. In Ireland's type of proportional representation system, this is difficult given its competitive nature. If we were to attract more politicians focused on the long-term future of the economy, we may need to alter that system. For example, the single constituency list of the Netherlands could provide a template. Dutch politicians represent the whole country without losing proportionality of the election results. And I think it is likely that there are policy experts, business people, or others who would consider devoting a period of their career to politics, but who don't want to run the risk of being a career politician with local responsibilities. National pride was hurt by the arrival of the Troika in 2010, but once the initial shock subsided, it gradually became clear that its stay would prove beneficial. And I certainly saw firsthand how the Troika introduced best practice in a number of areas, and in others provided the vital nudge. Certainly no spurious correlation between increased spreadsheet use and our overseas friends period in situ. Information sharing, collaboration, contingency planning, the lack of which was all highlighted recently at the banking inquiry, as failings of the 2000s have also improved. Fiscal transparency, as I mentioned, has increased sharply, primarily through the publication of the new government finance statistics by the CSO. But all the other arms, financial arms at least, of the state, publish many times more data in downloadable format than pre-crisis, although even more could be done. I think this modernisation process may help limit the damage from future tail risk shocks, as long as complacency doesn't creep back. As for the banking system, hopefully we'll never take our eyes off it again. Our banks are much more secure, and loan-to-deposit ratios for Allied Irish Bank and Bank of Ireland are pretty much in line. So loans are in line with deposits, whereas the situation we had 10 years ago was that you had loans double the size of deposits. Equity buffers too against losses now are significant and set to rise further as loan loss provisions from the crisis fade and shrink. There's another insurance policy in place too. The deleveraging and refinancing of the banking system has seen risk shift from Irish-owned banks to foreign providers of capital. Overseas funds and other shadow banks have bought billions of loans or properties outright. The good news is that if something goes wrong, in future in the property market, as it stands, the Irish taxpayer will not be on the hook next time, leaving aside the whole new resolution mechanism in the EU. We must avoid reabsorbing those risks at all costs. So if I was to paint this hypothetical scenario, our currently risk-averse banks perk up in 2 or 3 years and want to refinance those loans that have been sold to foreigners, or to fund new developments at a time of much higher property prices. Ireland's new bank regulatory regime won't really be tested unless such a scenario unfolds. And of course, the danger increases the more the crisis memory fades. So can we tell the future? I'm not so sure we can predict, but how might we think about spotting impending danger? And in some sense, there's a bit of crossover with Stephen here, in that the financialisation has been huge. After the last devastating crisis we had, we need to be much better prepared next time. Can we spot this trouble in advance? I'll argue that the tools which economists still use to anticipate recessions are faulty and some are possibly even redundant. It's a more dangerous world of high debt, low growth and cycles dominated by financial malinvestment rather than the typical business investment of the past. In the old days, recessions were typically caused by businesses overextending themselves, too much of capital, too much labour, too much investment in stocks, or what the Americans call inventories. Recessions tended to be shallower, but since the couple of quick-fire recessions of the US in the early 1980s, which is the price paid by the US and the world for chairman of the Fed at the time, Volcker's fight against inflation and the drive which he ultimately did to tame inflation, economic downturns have at least had some roots in finance and the reaction of central banks in the aftermath to the preceding ones. The more that inflation fell and productivity growth slowed, the more the global debt load grew. We've reached a point where the financial cycle is at least as important as the business cycle. This means we have to watch asset prices as closely as we watch consumer prices. And our dependence on the actions of central bankers has become disturbing. Yet, economist models have not really changed. Believe it or not, no mainstream models of the economy fully incorporated the banking sector pre-crisis. Some did not even include credit growth. Now the game has moved on again. Non-banks, or shadow banks as they're called, also known, maybe slightly derogatory and maybe slightly unfairly, have turned central bank money creation since 2009 into potential fuel for the next crisis. The large-scale macroeconomic models that we have, already an imperfect guide to reality, might be powerless to predict the next global shock, given that they don't incorporate any of these. Central banks have created trillions of dollars, euro, yen, from the push of a button over the last 6 years. And the majority has gone into bank reserves when they buy government bonds from those banks, or into the pockets of global funds in a similar way, only to be recycled into global assets. Ireland has benefited enormously from this global liquidity. Our reliance on overseas, particularly US investment, has snowballed in 3 ways. US funds, for example, sparked a rally in our government bond market in the summer of 2011. Ultimately, that priced out the expectation of default. They've been replaced now by more passive, but again, foreign investors. US private equity and hedge funds have also poured capital into our property market since 2012. And lastly and importantly, US multinationals have invested heavily, led by those internet and software companies, primarily moving into Dublin. I mentioned earlier the danger, albeit seemingly remote, of Irish-owned banks buying back the loans recently sold to those foreign funds sometime down the track. I think the risk is much greater that there is a future shock in some other part of the global financial system, leading to a flight of foreign capital and associated jobs from Ireland. Central bank money creation has pushed up the price of assets, equities or shares, corporate bonds and government bonds to high levels in most of the developed world. Meanwhile, businesses and governments in certain emerging market countries have been borrowing heavily in dollars. The US Federal Reserve prices global capital, and it's time, I think, for policymakers here, economists, and all of us really, to start watching closely as the American Central Bank nudges towards its first interest rate increase since 2006, a long time ago. It is a myth, though, that nobody warned about financial risks prior to the last crisis. The Bank for International Settlements, I won't take a show of hands on how many have heard of it, but it is slightly arcane. But it's known as the central bank of central banks, was vocal for many years but was ignored. And its warning bell is ringing again. The BIS is worried that QE programs, quantitative easing programs, and 0% interest rates implemented by central banks have underwritten risk-taking and sowed the seeds of the next bust. It feels that the Federal Reserve has waited too long to start raising interest rates. In its annual report, which was released just at the end of June, it wrote so: domestic policy regimes have been too narrowly concerned with stabilising short-term output and inflation and have lost sight of slower-moving but more costly financial booms and busts. And the international monetary and financial system has spread easy monetary and financial conditions in the core economies to other economies through exchange rates and capital flows, furthering the build-up of financial vulnerabilities. Short-term gain risks being bought at the cost of long-term pain. So to conclude, I want to again acknowledge Ireland's remarkable turnaround. Only 4 years ago, when Ireland was at its lowest ebb, I was sitting across the table from some investors, emerging market investors, that's how far we'd fallen, with a colleague in New York. And the first question was rather direct. They asked, so our question is not if, but when are you going to default? I think we've come a long way since then over the last few years. Thankfully that didn't happen, and it seems like an age ago now. In fact, today in the government bond market reviewed, as Sean mentioned, as closer to the well-behaved northern European economies than the other southern European economies that got into trouble like ourselves during the crisis. I'm proud of the work the government and all of us that were involved from the state's authorities put in to claw our way back. It makes the sense of needing to seize our second chance even more acute. Ireland has lots in its favour at the moment: an already competitive economy bolstered by cheap currency, low interest rates, the collapse in commodity prices that we've seen, and billions of foreign capital seeking to invest here. But there lurk still dangers. Dr. Pete Lunn, some of you may know of the Economic and Social Research Institute, he's a behavioural economist, outlined that one of the main human behavioural flaws of extrapolation was an important cause of the Irish banking crisis. We know the current sweet spot won't last forever, but we're hardwired to think it will. Therefore, we must do everything in our power to stay lean, to support our exporters, and never again become overweight like a decade ago. That means aiming to keep property prices close to their current fair value level and avoiding hikes in state-influenced costs. Fiscal policy has to now become strategic and lean against the cycle rather than pushing it forward. Ireland should aim to build a long track record of prudence and stability. I hope this year's primary service will be the first of a long, extended, unbroken run. Finally, be aware that the risk of a major further shock, another shock from global financial markets, is not far-fetched. Ireland has the opportunity to protect itself this time round, so let's not waste it. Thank you.